Forget the dream of a passive income laundromat with its advertised 95% 5-year survival rate. That figure is generated by the manufacturers, who profit the moment you sign a purchase order. It measures the storefront, not the owner. A store sold at a loss and reopened by a better funded operator still counts as a survivor in the data. This business is not a gold mine. It is a high-maintenance utility distribution center, where your biggest risk is an invisible leak in operating costs. You see clean floors and spinning drums, but you are not seeing the utility floor that stays fixed even when revenue drops. The industry is worth $7.2 billion, yet the math behind that survival rate is rarely questioned by those writing the first check. The primary source for this data is the Coin Laundry Association, often alongside promotional materials from manufacturers. This ecosystem relies on a steady stream of new buyers to sustain its scale. Yet the hard data reveals a contraction. The United States had approximately 17,461 laundromats as of 2026, a count that has been drifting downward for years. If this were a passive gold mine, storefronts would be multiplying, not vanishing. That 95% survival rate tracks the physical address, not the owner. When a store fails, it does not disappear. The equipment is liquidated, the space is refitted, and a new operator assumes the lease. The building survives, but the person who paid for it is often a casualty. Today, we tear apart the ledger to show you why your biggest risk is the silent, invisible leak in your operating costs. That leak happens the moment you sign the lease, hiding behind the promise of easy cash. You assume your utility bills move in lockstep with customer traffic, but water and gas are fixed floors rather than variables. A store running at 25% utility costs can quickly drift toward 40% without a single customer noticing a change. To understand if your storefront is truly a business or a trap, we have to look at exactly what you are buying. You are not just buying a storefront. You are stepping into one of two fundamentally different economic creatures. On one side sits the coin-operated model. It is designed for low interaction, relying on raw volume and machines that operate for coins and cards. You might visit to empty the coin boxes and wipe down surfaces, but the labor footprint is intentionally anemic. You trade personal labor for a heavy reliance on the equipment itself. If a machine breaks, your revenue stops, but your payroll remains near zero. You are a technician by proxy, constantly juggling maintenance logs and service calls. On the other side sits the premium service model. This is an entirely different architecture. Here, you are not just a landlord of metal drums. You are the owner of a service company. You offer wash and fold, pickup, and delivery. These value-added services can lift your gross revenue by 20 to 40% compared to the self-service model alone. That sounds like an escape hatch from the coin-operated grind until you look at the ledger. You are no longer managing machines alone. You are managing a staff. You have to account for labor costs, payroll taxes, and the shifting reliability of human beings who might not show up for a shift. In the premium model, 15 to 25% of your total revenue is immediately earmarked for payroll. The two models share the same fluorescent lights and the same row of dryers, but they are playing different games. The coin-operated store lives or dies by its utility drift and equipment uptime. The premium service store lives or dies by its labor efficiency and throughput. One fails because the machines consume more than they produce. The other fails because the service model cannot generate enough margin to cover the human beings running it. You are choosing your own structural risk at the point of sale. For a small store, a budget-conscious build-out using used equipment might start in the $50,000 to $100,000 range. But if you move up to a mid-sized store with commercial-grade equipment and proper renovations, your entry capital jumps to a yiddle between $200,000 and $500,000. If you decide To bypass the headache of a new build-out and acquire an existing laundromat, the price tag can easily climb from $200,000 up to $1 million or more. These numbers represent your sunk entry cost, but they tell only half the story. You are not just buying machines. You are buying the right to tap into the local utility infrastructure. The true cost of the store is often hidden behind the walls. You might assume your biggest expense is the shiny row of washers, but the reality is a massive, invisible sinkhole. The plumbing, gas capacity, and sewer hookups required to bring a commercial space up to code. Often, the cost of these structural necessities, the trenching of concrete to install oversized drainage, the upgrading of gas lines to feed a dozen high-heat dryers, and the complex electrical load balancing, exceeds the purchase price of the machines themselves. These are not optional upgrades. They are the fixed backbone of your entire enterprise. Once the concrete is poured and the lines are buried, you are locked into a permanent, immovable physical configuration. You cannot easily pivot or downsize if your volume projections fail. You are paying for capacity that must be maintained, whether the store is packed with customers on a Sunday afternoon or sitting empty on a Tuesday morning. This is a permanent commitment you make the moment you sign the lease. Every square inch of that space, every valve in the back room, and every inch of piping under the floorboards is a liability you must service every single month. Your cash flow is now inextricably tied to this infrastructure, and the bank does not care if your machines are spinning or idle. They care about your debt. This is the moment where your initial investment becomes a fixed monthly anchor. You have spent your capital, and now you must face what that capital has committed you to every 30 days, regardless of your revenue. That monthly obligation is where the entire dream either sustains itself or begins its slow collapse, and that is where we need to look at the interest burden you have just taken on. That interest on your startup loan is a silent, monthly deduction that bites before you wash a single pair of socks. If you secured a loan of $200,000 to build or acquire your store, those payments are locked in. Even if a single customer walks through your doors, that debt maturity schedule does not blink. It is a fixed, non-negotiable anchor that drags on your cash flow every 30 days. To keep your head above water, you must balance this against your primary overhead. Industry data consistently shows that rent should remain under 25% of your gross revenue to keep the shop viable. Once your rent exceeds 30%, your ability to remain profitable begins to buckle under the strain of your own fixed costs. When you layer in your monthly insurance premiums, commercial taxes, and the base cost of your loan, you arrive at your break-even load. This is the absolute minimum volume of laundry cycles you must process just to stop the bleeding. Most first-time owners arrive at this number only after the lease is signed and the equipment is bolted to the floor. They realize too late that the margin between their revenue and their fixed liability is razor thin. It is a dangerous gamble to assume that the customers will arrive in sufficient numbers to cover these rigid, immovable debts from day one. You are not just managing a retail space anymore. You are managing a high-pressure infrastructure tier where the math must be perfect from the start. But even when your revenue hits that target and your break-even load is met, you are still staring at a hidden vulnerability. Even when the coins drop into the machine and the lights stay on, something else is happening behind the scenes. Your profit is not just a function of the customers you serve, but of the energy you bleed into the void. Here is the utility elasticity trap. You assume that when business slows, costs fall with it, but in a laundromat, utilities are a floor, not a slope. Water, sewer, gas, and electricity typically consume 20 to 30% of gross revenue, and a well-run store with modern high-efficiency machines can hold near 15%. The same store with aging equipment or poor maintenance drifts toward 40%. Nothing about that drift is visible on the sales floor. Your customer count is identical, your machines look identical, and your margin has been cut in half because efficiency is fixed at the moment you buy the machine, and every utility rate hike after that is charged directly to your bottom line. Think about the math of a typical machine. You are paying for the water to fill the drum, the gas to heat it, and the electricity to rotate the motor. That cost is baked into the plumbing and the machine's internal valve design the day it is installed. If a city board approves a 10% water rate hike next quarter, you cannot negotiate with your machines to use less water, and you certainly cannot negotiate with your customers to pay 10% more for a wash on a Tuesday morning. The expense is inelastic. You simply absorb it. Most owners treat this as a static line item in their business plan, assuming this percentage remains constant. That is the fatal oversight. As your machines age, seals fail and heating elements lose efficiency, causing the utility draw to creep upward. You might notice the machines seem a little slower or run a cycle a few minutes longer, but you rarely equate that to a 3 or 5% drop in your net margin. It happens in the background, a silent, invisible tax on your operation. This is where the distinction between a healthy asset and a liability sinkhole becomes clear. If you operate an older store, that utility drift is likely already occurring, steadily eating your potential profit while your revenue stays perfectly flat. You are managing the store, you are cleaning the floor, and you are fixing the occasional coin jam, all while your primary overhead costs are drifting upward without your knowledge. Now, consider what happens when we look at the specific ledger impact of this drift. If a store pulls 25% of revenue for utilities, a spike that pushes that figure toward 35 or 40% is not just a budget adjustment. It is a fundamental destruction of the capital you intended to collect as profit. This is the moment when the business stops paying you and starts paying the utility company, forcing the question, what happens when your operating costs finally cross the threshold of your incoming cash flow? That threshold is exactly where the math stops working in your favor and starts working against you. When you move from a controlled 25% utility cost to the 35 or 40% range, you are not just seeing higher monthly bills. You are witnessing a permanent erosion of your margin that no amount of local marketing can fix. You could double your promotional budget or polish the stainless steel floors twice a day, but that utility drift is anchored to the very architecture of your equipment. If you bought older, less efficient machines to keep your entry cost lower, you are effectively paying a permanent, invisible tax on every single wash cycle. This tax is completely transparent to the customer, but it is absolute and unforgiving on your ledger. Now, layer in the maintenance bleed. Industry benchmarks consistently place maintenance and repairs between 15 and 20% of your total operating costs. If you are diligent, you handle the small stuff yourself, but those inevitable service calls for major machine failure will cost you between $120 and $500 each time. You need professional help. A single malfunctioning dryer can cost you hundreds of dollars in lost turns while you wait for a back-ordered part to arrive. In a store with 40 washers, losing just one turn per machine every day means you are hemorrhaging approximately $64,800 in monthly revenue. That is gross revenue walking out the door because a bearing failed, a coin drop jammed, or a door latch stopped clicking. When you assemble these figures, the reality of the business comes into sharp focus. Total operating costs, including those stubborn utility floors and the inevitable cycle of repairs, typically consume 65 to 80% of your total gross intake. That leaves you with a razor-thin buffer to cover your rent, commercial insurance, loan interest, and your own remaining profit. If you have significant debt, that fixed monthly payment does not care if you suffered 3 machine breakdowns or an unexpected municipal water rate spike. It hits your operating account like clockwork. This is why the dream of passive income evaporates the moment you look at the real, day-to-day requirements of the floor. You are not a landlord collecting passive rent. You are the lead maintenance manager of a high-wear industrial utility plant. You are either turning a wrench yourself to keep those metal drums spinning, or you are paying someone else to do it, which further cuts into that narrow, precarious margin. This leaves us with a critical, uncomfortable realization. If the store is kept clean, the pricing is competitive, and the machines are generally functioning, why does a seemingly viable business suddenly collapse? We have identified the utility traps, the maintenance sinks, and the crushing weight of fixed debt. We know that the margin is tighter than the glossy brochures suggested at the point of sale. Yet, we still have to account for the specific, rapid sequence of events that turns a functioning storefront into a terminal liability. The breakdown happens when a high-performing storefront encounters a cluster of fixed cost spikes that outpace your cash reserves. You are running a facility that generated $504,000 in annual revenue, but a rent escalation, which should ideally hover around 9%, hits a friction point with your underlying lease. When that rent expense drifts, it shrinks your margin before you even account for the reality of high-wear infrastructure. Then, a water line ruptures. It is not just the immediate service call, which can range from $120 to $500 per visit. It is the secondary cost of operational silence. When machines sit idle for 3 months due to a combination of maintenance delays and cash flow bottlenecks, your revenue drop is absolute. Demand from your customers never actually dissipated, but your ability to capture it did. Because you lack the resilient capital, that vital buffer of roughly 20% of annual revenue. To absorb 2 consecutive quarters of negative cash flow, your position becomes terminal. You are locked into your lease and your debt service obligations, both of which remain as fixed and demanding as the day you signed. This is the moment the industry data masks the individual cost of entry. You do not reach the end of your contract. You sell the store to a better capitalized operator who can afford the capital expenditure required to bring the equipment back to peak efficiency. The machines are repaired, the signage is updated, not a floating utopia, and the location begins its next 5-year cycle under new ownership. Because the storefront itself never stopped serving the community, it remains a statistic of a surviving business in the trade association records. The facility is a success, but you are the casualty. To understand how that reset happens, we look at how thin the margins actually are when things are going right, and how quickly they vanish when they stop. We construct a laundromat at roughly $504,000 in annual revenue to see exactly where the money goes. With $504,000 in annual revenue, your baseline financial model looks predictable. If you run a lean coin-op shop, your rent claims 9% or $45,000. Your utilities, held at a disciplined 25%, consume $126,000. Maintenance and insurance take another 20%, roughly $100,000. After debt service, you pull a net profit near 25%, or $126,000. It is a clean, steady picture of a small utility provider, but that math relies on a machine environment that operates without friction. Now, apply a single quarter of operational reality. You face 3 machine failures simultaneously, costing $1,500 in service calls. A water rate hike hits, and because your older equipment is less efficient than the premium models, your utility load drifts from 25% toward 35%. Suddenly, you are paying $176,000 for utilities alone. Your rent is a fixed anchor. Your debt maturity remains unchanged, and the lost uptime from your broken machines drags your annual gross revenue down by $54,000. Your net profit does not just dip, it evaporates. The coin-op store dies from this utility drift. Because you rely on low touch volume, you have almost no levers to pull. When the utility bill rises, your margin shrinks dollar for dollar, and you are trapped by the physical efficiency of the hardware you purchased years ago. The premium model, which uses wash and fold services to lift revenue, faces a different collapse. You are saddled with a payroll burden that you cannot shed fast enough when volume shifts. The labor required to manage those value-added services becomes a high-cost liability the moment your utility overhead spikes. The gap between your initial pro forma and this reality is not a minor fluctuation. It is the difference between a functional, cash-flowing business and an asset that effectively works for the utility company and the landlord while you pay to keep the doors unlocked. In the first scenario, you are a business owner. In the second, you are a maintenance manager paying a premium to house heavy equipment. The coin-op model lacks the resilience to handle the drift, and the premium model lacks the flexibility to cut its largest fixed labor cost during a downturn. This is why the store survives even when the owner does not. You are playing an industrial game, and the math of that game was decided before you signed the lease. You are not a business owner in the traditional sense. You are an infrastructure manager whose paycheck is tied directly to the durability of your hardware. Your profit is not found in the coins. It is manufactured through the rigorous avoidance of downtime. The 95% survival rate is real, but it describes the endurance of the equipment and the utility grid, not the operator. When a store changes hands after a bad quarter, the data counts it as a survivor, while you count your losses. A laundromat that requires no attention is a business that pays no dividends. Your greatest asset is not the machines themselves, but your ability to repair them before a failure costs you a turn. This video is for education and entertainment purposes only. Consult with qualified professionals before making any significant business decision.